Okay, so great. Now I can't see your guys' questions. So what I was going to say was we'll take questions at the end. But now that I can see your questions, please, 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 if you have any questions throughout the presentation, interrupt me and ask them, because with the number of people who are in here, there's a lot of you guys in here. I guarantee that if one person has a question, there's at least a dozen other people with the same question who just won't ask or are too afraid to ask. But you should ask a question. Please don't feel like you don't know what you're talking about for asking a question. That is why we're all here in the first place, is to learn something new. So what I'm going to be talking about today is how I choose longer-term trade setups using unusual options activity. Now, how many of you in here have never heard the term unusual options activity before? Or maybe, you know, don't know the first thing about options? Because I know we have a very wide array of speakers that were in this event. So yeah, never heard of it before. Right. So unusual options activity is a concept of following institutional order flow and looking for block trades. So the way that we're going to go through this is pretty simple, right? We're going to kind of start out with the philosophy behind the trading plan and the reason why I care about unusual options activity. Then we're going to take a look at what unusual options activity is and how I can identify institutional order flow in the equity options market. Then after we're done with all of that, we're going to go through, okay, once I've identified that order, or identified this unusual options activity, how do I then take advantage of that order flow and information that I can glean off of that order flow in an actionable trading plan, okay? So at any point, like I said, if you have any questions, please feel free to ask. But we're just going to go ahead and jump right in here. I'm going to read our standard boilerplate risk disclaimer here before I get started. Day trading, short-term trading, options trading, and futures trading are extremely risky undertakings. They generally are not appropriate for someone with limited capital, little or no trading experience, and or a low tolerance for risk. Never execute a trade unless you can afford to and are prepared to lose your entire investment. All trading operations involve serious risks, and you can lose your entire investment. No trades are recommendations or advice, and we cannot be sued for losses of capital. All trades are for educational purposes only. Contact your broker or registered investment advisor for execution, margin, and capital requirement questions. Everyone watching the presentation here's all disclaimers on optionshacker.com and KeenOnTheMarket.com. Okay? So I'm not going to spend too much time talking about myself because Dan did a really great job of introducing me there. But my name is James Ramelli. I'm a trader and moderator here at KeenOnTheMarket.com in our live trading room. I'm also our head options educator. So I actively trade equity options all day long. I do trade futures, forex, and stocks, but 95% of all of my trading surrounds equity options. Okay, so today, when I first jumped on here and we tested the screen, you guys saw my trading setup, and what you saw was a lot of stuff happening in one place. But I trade with a setup with 6 monitors here in Chicago across from the Board of Options Exchange. And all I'm really doing all day long is looking for unusual options activity and putting on some smaller catalyst type trades as well. But my main focus is unusual options activity. Okay. Someone says, do not know how to place or exit options. Okay, yeah, we're going to talk about all that, right? Not an option to order trade, order flow, block trading versus candles, etc. Yeah, I mean, I think then we're going to talk about how I combine both my, views on technical analysis and my views on unusual options activity in one kind of comprehensive trading plan. So let's go ahead and jump right in. But before I get to the actual identification of unusual options activity, let's talk a little bit about the idea behind the trading plan. So it is a sad statistic, and this is actually a true statistic as well. You can look this up, but 90% of all retail traders lose money. 90% of all retail traders lose money. And, it's not a statistic that makes us feel good, right? We would like to see retail traders be successful, right? I am also a retail trader. I trade from a retail brokerage account behind the screen just like all of you guys do. But one of the main reasons that the majority of retail traders lose money is because the ways that you need to think about trading, especially when you trade options, can oftentimes be counterintuitive, okay? Your first instinct always feels right, and that's just human nature, right? So if I buy a stock and I see it move lower, my intuition is going to say, hey, if I liked it before and now it's cheaper, then I should like it even more, and I'm going to buy more. But that's not really the way that you should be trading, okay? That's a very emotional, reactionary way to trade, and you need to kind of train your brain differently to think more in terms of how a successful trader might think about things. Okay, so all of our trading plans are written in a way that kind of focuses on that and makes it easier to do so. Okay, it makes it easier to stay disciplined, to follow the plan, and to remove emotion from the game a little bit more. Right? I can write a trading plan, but if it's difficult to follow and there's too much room for error or discretion or emotional decision making, then it's not really going to be a strong trading plan in the long run. Okay? 1 in 10 traders is profitable. Only 1 in 10 people is able to figure that out and start to think in the way that makes them successful. Okay? And I think that using a trading plan that kind of forces you to stay disciplined and forces you to have multiple levels of confirmation for every setup that you look at is the best way to remove emotion from the game. So the key to trading success is emotional discipline. Paul Tudor Jones said that. Does anyone not know who Paul Tudor Jones is? Has anyone never heard of Paul Tudor Jones? Right? But he's a pretty successful trader, right? Wildly, wildly successful hedge fund manager. And, if asked what the key to trading success is, he would say it's emotional discipline. All right? So with that in mind, I know I have to have a trading plan that keeps me very disciplined. Okay? But the best trading plan doesn't work if I don't follow it. All right? But is that really what makes Paul Tudor Jones the successful trader that he is? Or is there something else at play here? And I want to talk a little bit about institutional edge. Okay, so is it really that easy for Paul? He's just able to turn off his emotional decision-making part of his brain, follow whatever his trading plan is, and make money? No, right? Institutional traders have advantages that retail traders simply do not have access to. Okay, and even if they're all following the rules and nobody is using any non-public information, the sheer size and capitalization of these institutions makes them, gives them more edge than a retail trader can have, okay? I have access to all of the same data feeds and tools that you guys would have access to, right? I use thinkorswim for my trading. I use a couple of other indicators, but they're all designed for a retail trader, okay? Institutional traders have so much capital behind them that they are able to afford technology and technology and information that we simply cannot afford, right? There's just no way. There's no way that I can pay to co-locate my server. There's no way that I can pay to have all of the processing power to crunch numbers. There's no way that I can pay PhDs from MIT and Harvard to, tweak models on thermodynamics and physics to do analysis on an HFT model that I might have, okay? There's no way that I'll ever be able to do that. So institutions have access to all of these things that I don't have access to: manpower, capital, technology, and information, okay? So knowing that I can't access that information or those things and advantages that give them extra edge, how can I take advantage of the fact that they have access to it? Well, I can try and look into their order flow and see where it is they're putting their money. Okay, if I can see where institutional traders, especially in the equity options market, are putting their money and allocating their risk, well, I can basically take advantage of all of this extra information, all of the technology, all of the work that has gone into one of their trading ideas without actually having access to or having to do it myself, right? I just need to be able to recognize the order flow. Okay, now this might sound, for those of you that are not that familiar with options, it might sound difficult to do, right? If I was looking at a stock, I could look for big block trades in the stock market all day long. But the problem with that is most liquidity in the stock market is now off exchange, and large institutions and traders who are looking to put on large speculative positions, well, they have the ability to do that outside of the exchange, somewhere where I will not be able to see the order flow. or unusual options activity is any order in an equity option that is above the average daily volume for equity options in a given stock. Okay, so if on average every day across all puts, calls, expirations, and strikes, stock XYZ trades 5,000 options, and then I see someone come in and buy 10,000 out of the money calls, well, I know that that is unusual options activity, okay? But these orders give me insight into institutional order flow, okay? Because if I'm only looking at the massive bets hitting the tape, I know that this is institutional money. It's not someone sitting at home, you know, putting on an $8 million bet in GE equity options, okay? Or putting on $1 million bet in Altera equity options, okay? Retail traders can look at the order flow in the equity options market and see where the smart money is going, okay? Now, you might not think that, you know, hedge funds or institutional institutional traders from big banks are the quote-unquote smart money, but they do have access to information that we don't, and they do oftentimes place trades based on information that they're not supposed to have, okay? And this is a statistic that came out last year. It was unusual option activity kind of came into the spotlight for a little while when Andrew Ross Sorkin, who's a respected financial journalist, wrote that 25 to 30% of all M&A deals that take place have some type of unusual options activity ahead of the deal. There's some type of telegraphing order flow, be it traders buying out of the money calls, getting long or getting short a stock before news comes out and affects the price of the stock. There usually, you know, 30% of the time there is some type of order, okay? And we're going to look at examples of that a little further on here. How do you know if unusual volume is buys or sells? That's a really good question, and I have an example here in a couple of slides that should clear that up. But it's all about looking at the price where it traded and the market at the time, and I'm able to do all of that with some very simple tools, so I'll show you guys. But it really all starts with honing in on the orders that are speculative bets. If we think about the participants in the equity options market, there's two main participants in the equity options market, right? There's hedgers and there's speculators. Hedgers are coming in and trading equity options to protect themselves against adverse moves in positions that they already have, okay, in the underlying stock. Speculators are coming in and trading equity options in order to speculate on the direction of the stock, speculate on changes in implied volatility in the options market, or to just take a view on time. Okay, so orders hitting the tape are not always as they seem. A lot of people that first start looking at trading unusual options activity and reading equity options order flow make this mistake. They'll see a big block of calls being bought and they'll automatically say, okay, that trader is looking to get long this, it's a very bullish order. That's not always the case, okay? If a trader buys calls, they could be speculating on bullish moves in the stock, or they could be looking for a hedge against short stock that they already have. They could be shorting stock against those calls. When a trader sells calls, it's not necessarily bearish. Most of the time, when a trader sells calls naked, it's against stock that they already have. It's known as a covered call, right? That's the only non-speculative options position according to the OCC. All right. If a trader buys puts, are they speculating to the downside, or are they hedging a long stock position that they have? If a trader sells puts, are they trying to get long, or are they protecting a short stock position? A trader can sell puts against short stock. It's called a covered put right, okay? That creates a dividend stream in a short stock position, all right? It's not a very common trade, but a put being sold can be a hedge or speculation. So any trade hitting the tape can be speculation or can be a hedge. And I can actually never know with 100% certainty whether or not an order hitting the tape is a speculative bet or a hedge against an existing position. It's my job to determine which scenario is more probable, okay? So I can never say for sure this is a hedge, this is a speculative bet, but I can, you know, through a way of analysis that I'm going to show you guys, I can determine what is the most likely scenario, whether it's more likely they're getting long a stock when they buy calls, or whether it's more likely they're hedging a short stock position when they buy calls, okay? So I want to focus on the speculative bets. I don't want to be buying a trader's hedge. So it's all about filtering out those hedges and focusing on the speculative bets, right? as I said, you shouldn't be taking trades at face value when they hit the tape. About 70% of the time when calls are bought, it's bullish, but about a third of the time, it's actually protection against short stock, okay? And the same thing goes for all these other types of trades that you might see hitting the tape. In fact, it actually gets more complicated than what we see here. Traders trade all kinds of strategies to hedge positions and make speculative bets. Trades are not necessarily what they seem. So I do need to have some basic level of options knowledge to follow unusual options activity, because I'm going to see a ton of orders hitting the tape in a day, and it's going to be very difficult for me to read through all of them. If we take a look here, this is one of the tools that I use to read the tape. And as you can see, it's a ton of information. I'm not going to go over this in detail. We have another example further on here, but it's a ton of information, okay? We see all types of spreads hitting the tape, all types of calendar spreads, reversal conversions, combos, buy rights. You know, it's difficult to read if you don't have a systematic way of doing it and a systematic way of filtering out the trades that I shouldn't be paying attention to, okay? So what do these orders look like? So I'm going to show you guys an example of an order that hit the tape here. And this is an order that hit in ALTR. Okay? So there's a lot of information inside of each of these little snippets that I can see hitting the tape in a given day. Oops, sorry. One too far. Too far. So I have a lot of different information here. Okay? Someone asked at the very beginning, how do you know if unusual volume is buys or sells? Okay, that's what the first question someone asked. Well, I can see all of that here because every trade that takes place in the equity options market has to be traded through a public exchange. All of the information relevant to that trade is public as well. I have to be able to see it. So I'm able to see the size of the trade, the stock that it traded in, the expiration, the strike, whether it was a call or a put, the price the option traded at, the time the option trade took place, and this is here the most important part, or one of the most important parts. I can see the exchange and the bid and offer at the time of the trade. Okay, so if I see that this market was 25 cents at 35 cents when this trade took place, and the trader paid 35 cents, or paper paid 35 cents, institutional traders are often referred to as paper on the trading floor, then I know that they most likely bought these, right? If they're lifting the offer, they're not working an order in the middle, or they're not hitting the bid at a quarter, I know that they're most likely buying these. I also know that because the trade is labeled opening. Technically speaking, all equity options trades that are opening positions should be labeled as such, okay? They are not always labeled opening, though. Sometimes brokers get lazy, sometimes they just don't do it, okay? But I want to be following opening orders only. Someone said, how do you know if it's a buy or a sell? Well, that's almost less important than knowing whether or not the trade is opening or closing. Okay? If I'm long calls and I see a big block of calls hitting the tape, all right, let me put it this way. If I'm short calls, say I'm a hedge fund and I'm short 10,000 out of the money calls, well, I want to buy them back. Okay? I might buy them back. I might lift the offer to buy them back and cover the position. Well, me as the retail trader, or you as the retail trader, would see that order hitting the tape and say, hey, look, someone's buying a bunch of calls, not knowing that I am closing my position. So you might try to jump in at that point when I am actually getting out of my position and covering a position that had nothing to do with speculating to the upside. So we're going to talk about how to identify opening versus closing orders as well, because all closing orders should be completely ignored. I don't want to pay attention to closing orders at all. Okay? So does anyone have any questions so far? Does anyone have any questions so far? Oh, so this is, yeah, someone says delta equals 100. What does a sweep mean? So a sweep, this is a type of order when there is a market of 25-35 and a trader wants to get filled at a certain size and there isn't enough size there. They cannot pay more than 35 until they clear out or sweep all of the exchanges and clear out all of the offers. So a sweep is actually a little bit more aggressive of a buy. Okay? Yes. So someone asking where to get all of this data. I will go over that here a little bit when we get a little bit further into the trading plan. But I want to, so yeah, a filter to flag for high volume. I mean, one thing that I want to understand is that it's not really unusual options activity unless more than 2 times the average daily volume has traded in the name. We use a 22-day moving average, okay? Someone says, quick question on Thinkorswim. If options volume is 2,000 so far and open interest is 3,000, does that mean you can only buy 3,000 contracts like what you have on screen now, 2,958 contracts? Did the open interest have to be higher than 2,958? No, absolutely not. Actually, if I'm seeing 2,000 contracts trade against 3,000 in open interest, I don't really care about the trade because it's not likely to be an opening position. Okay, market maker makes a market. Okay, I can come in and say, I want to buy 50,000 out of the money calls in the SPY on a strike that has 0 open interest, and they'll make me a market. My trade will get executed, right? So open interest has nothing to do with how much volume can trade in a given line. It has nothing to do with it. Okay. So how are these orders executed? And this might clear up your question a little bit more, Lou, about how these orders are traded and exactly what goes on. But an institution creates an order based on research, information, and analysis. Okay? Now that's no small feat. I am one person, and no matter what I do, I will always be one person who can only spend so much time doing research, looking for information, and doing analysis. Okay? I cannot do more than one person's worth of work. I've tried, it doesn't work, right? A hedge fund might have a whole team of quants and analysts poring over financials, looking at technicals, doing regression models, trying to find out what the true value of something is. And once they're done with all of that analysis and research, they will then place an order based on their findings, right? So a lot of work goes into that order before the trade is executed. So I have to understand there's a lot of value in being able to recognize their orders when that much work goes into them, okay? So they come up with a trading idea. They call their brokerage to get the trade executed. The broker might shop the order around to trading desks all over the place, Citadel, Goldman, Barclays. When the trade, if it does not get filled at any of those, then they'll send it to the pit, and the market makers will make them a market there. If not, the trading desk outside the pit will execute the trade. If not, the firm, their brokerage firm, might take the trade themselves and hedge it. What's important to understand is that as soon as the trade takes place, it has to take place on a listed, on an exchange somewhere where I will be able to see the orders. So they're not able to hide their order flow like a big institution trading trading equities might. I have, as an institutional trader, as a hedge fund, as a mutual fund, as a pension fund, I have a number of off-exchange centers for liquidity that I can get my equities orders executed in, okay? By 9:30 in the morning, after the market has been open an hour, Citadel here in Chicago, down the street, has already traded more volume than the NYSE will all day, okay? As of right now, that isn't a dynamic that's present in the equity options market. All of the orders come across the tape, and I can see all of the orders too. Okay, so a lot of the time and expert analysis goes into these trades. That means that they're worth watching, and the fact that they have to be conducted on a public exchange means that I have to be, that I'm able to see it. I'm able to see their order flow, and it's just about recognizing it. So let's look at some more examples of unusual options activity here, okay? So we had an example earlier in ALTR when we looked at that order flow. This was an example that hit the tape on a Friday, the week before expiration, okay? I'm sorry, it's hit on March 27th with less than an hour to go to the close. Shortly after the trade hit the tape, the stock was halted and ripped higher on M&A news. So let's look at the chart through the close and through the open on Monday. Now what's really important to understand here is that this order is an unusual options activity trade because it trades at a multiple of ALTR's average daily options volume, okay? It gets flagged, all right? And we use a scanner called Trade Alert to look for these things. It's relatively inexpensive. And we also offer a scanner of our own called Option Hacker that looks for this type of institutional order flow. But with only a few moments to go to the close, less than an hour to go to the close on a Friday, when I see them coming in and buying this line of calls, and you have to understand that when they're buying almost 3,000 out of the money calls here for 35 cents, it's a $100,000 bet. Okay, so I know that that's got to be an institutional trader. And the fact that it's happening on a Friday before the weekend is all kinds of suspicious, right? Options have time decay. So if I'm an equity options trader who buys a huge amount of premium, $100,000 worth of premium ahead of the weekend, I have to understand that I'm going to be exposed to that time decay over the weekend. So really would I do that unless I knew something was going to happen in the stock, or if I suspected that there might be some kind of news in the stock? Okay, so what happened here after this trade hit the tape? So the trade hit the tape, and moments later, the stock was halted. Okay, when the stock reopened, the stock ripped to the upside on acquisition news, and these calls exploded in value. Now, someone said somebody traded on insider information. I really don't know. I honestly have no idea what this person knew. Maybe they just got lucky. I really don't care, okay? Because even if they did have insider information, meaning non-public information that would be illegal to trade on, as soon as they execute their order and I see it hitting the tape, if I say, hey, that looks like a suspicious order, maybe this is worth a little bit of my risk, I am trading on public information, okay? Their order is public information. If they've done something that they weren't supposed to, it doesn't really matter to me, okay? Being able to recognize this type of suspicious order flow and taking advantage of it can be extremely, extremely profitable, and is, completely, on the level in terms of regulations, right? There's nothing wrong with looking for suspicious order flow and taking trades off of it, okay? So after these calls hit the tape, the stock absolutely exploded to the upside. We see a huge move higher here in ALTR. All right, I don't remember exactly who said they were thinking about buying ALTR. I believe it was Intel, or there was rumor that Intel was going to be putting a bid in on ALTR. And the stock exploded to the upside and actually continued higher through Monday. Okay, so I mean, this is where they buy calls and halt the stock, and then we open up and rip higher to this point, gap higher, and continue moving higher. So how did this trade work out? What would a trader's profits would be like if they had taken this type of position? Well, the stock continued higher on Monday, and the calls exploded in value, and they actually traded as high as $7 since they were bought. If a trader bought 20 of those, they would have been profiting over $13,000 at the highs. This is a fantastic example of unusual options activity ahead of M&A deals. Okay? Now, I don't want you guys to think that every single unusual options activity trade is going to play out like this. It's not. Okay? It absolutely will not. Over the last 2 years, I've probably caught about 5 or 6 unusual options activity trades that were ahead of really large M&A like this. Okay? I had several positions where I saw very similar type moves. I saw a block of, some calls that I bought for 40 cents or 50 cents go to $7 or $8. Now, that's not typical, right? I don't want you guys to think that every single time you take an unusual option activity trade, you're going to see your, your money multiply by 200, right? It's not going to happen every time. But like we said, it has been shown that there are, at least in 25 to 30% of all M&A deals, some type of telegraphing unusual options activity ahead of the event. Okay? ALTR happened just very recently. Okay, well, within a week of that happening, we also saw something very interesting happen in Kraft. Okay, so Kraft announced the acquisition of HNZ But would you believe that even in a company as big as Kraft and a deal as big as the Kraft HNZ merger, that there was UOA that telegraphed that perfectly? So on March 10th, a trader bought 10,000 Kraft June 67 half calls for 70 cents. Okay? This bet is a lot larger in terms of size, right? How much capital does this trader tie up in this trade by buying 10,000 of these for 70 cents? Well, they are betting $700,000 that Kraft will be above 67.5 by expiration in June. Okay? So they did that on the 10th. All right? Near the end of the month, I think it might have even been in the same week as ALTR. Near the end of the month, they come in and they say, hey, we're going to merge with Heinz. We're going to pay a special $16 dividend to all of our shareholders, and we're going to become one of the largest food conglomerates in the world. The stock exploded to the upside. These calls traded as high as $22.70 since then. That's a $44,000 profit on a 20 lot. So on $700 or on $1,400 worth of risk, a trader could have seen profits of $44,000. I actually missed this one and did not buy any Kraft ahead of this. I was kicking myself for days. A lot of our subscribers in the trading room took advantage of this order by recognizing it as unusual options activity. Took advantage of this order, got long Kraft with a 50 lot or a 100 lot, and saw six-figure paydays on the announcement of the merger. Okay, so it can happen. Being able to recognize the order flow can lead to profits like this, but they are not typical, right? It's not going to be what I see every single time I place an unusual options activity trade. What is more typical of returns on unusual options activity are returns like we're going to look at here in the next couple of slides. So before we jump into the actual trading plan here, meaning once I see an order, how do I take the trade, let's talk about and recap for a moment why we care about this order flow and why it's important. Well, hedge funds and big traders simply have more information than us. Okay, it's not necessarily to say that they know non-public material information. A lot of them do, right? A lot of them do. We all know this. That's not necessarily what the motivation behind this trading plan is. The motivation behind the trading plan is that even if they don't have non-public information, reading into their order flow is important because it tells me what the end result of all of the technology analysis and man hours that have gone into their trade setup is. It's hey, we're buying these calls, or hey, we're buying these puts. Okay? Having capital allows them to buy better information. That goes without saying. Okay? Bloomberg Terminal is one of the best sources for financial data in the world, right? I can access any piece of financial data that I want on a Bloomberg Terminal for $25,000 a year, okay, to have one. And even if I did have one, I'm only one guy. I'm only one person. They have teams of people poring over this stuff. So it's like being able to see through the eye of Carl Icahn or David Einhorn and see what their positions are before they have to disclose them. A lot of these activist investors, and we've seen some really good UOA happen, based on activist investor activity, right? Not necessarily merger and acquisition deals. But a lot of these guys will use the options market to start building their position before they actually disclose and to say to the public, hey, we're taking a X amount stake in company XYZ. All right? I can tell you exactly when Bill Ackman rolled his Herbalife short forward. Okay? I saw it happen, and I knew that no one else out there had enough capital or was trading size like that to place that order in puts that we saw hitting the tape, okay? A day later, CNBC reported that he rolled his short forward. We all knew it ahead of time, right? Anyone who was watching the tape knew it ahead of time, knew it way before it was reported on the news, okay? So someone says, can you do a demonstration of an unusual options trade that shows what an unusual option size is? What do you compare to the average daily amount of options? Okay, so yeah, that's a really good question. So someone's asking, how do you know exactly what unusual volume is? So there's a couple of different ways that I can look at it, right? And this is kind of the only place that discretion comes into play in the trading plan. Okay, so Kraft, 10,000 calls controls what? 1 million shares of stock. Okay, 10,000 calls controls 1 million shares of stock. Well, Kraft trades 7 million shares a day. So is that an order that is incredibly, needle moving in Kraft? Maybe not, but the way that the order hits the tape, they're paying the offer for a 10,000 lot of calls when we never see that type of size in Kraft. That is something that raises a flag, right? So I can look at a lot of different things. A stock might trade a lot of options in a day, but not in large blocks. So then when I see a large block hitting the tape, that's intriguing. A stock might not trade very much stock in a day, and something as small as 1,000 lot could be considered unusual options activity. Okay? Think about the process of what happens when an order gets executed. Okay? And this is something that makes certain orders more intriguing than others, right? If I see, for example, a 10,000 lot of calls being bought in stock XYZ, and then I look to see that the stock volume, not the options volume, but the stock volume in stock XYZ on average is 500,000 shares a day. Well, I know that someone just came in and paid for the right to get long 1 million shares of that stock at a certain price. Okay? That's 2 times the average daily stock volume, 2 times the average daily float in that stock. It's a more significant order. Okay? It's a more significant order. So unfortunately, there isn't one blanket statement I can give you that says, hey, only look at orders in stocks that trade under this amount of stock volume, only look at orders that are above this lot size, because everything is relative, right? Everything is relative. Every stock trades differently. Every stock has its own average daily volume. Every equity has its own average daily equity option volume, okay? So it's all relative. I can't really tell you exactly what to look for, that would cover all situations, right? But it's all about looking for the unusual trades, okay? So all of these trades are public information. That makes sense. Unusual means unusual, right, exactly. So unusual just means it's unusual. It can be unusual in terms of the amount of money that they're putting into the position. So, maybe Kraft trades a lot of stock in a day, but putting on a $700,000 bet in Kraft options is something that doesn't happen that often, right? Just like what we're going to look at here, an example in a few minutes, we're going to look at an example in GE. How many shares of stock does GE trade in a day? Anybody? Does anybody know how many shares of stock? On average, GE, General Electric, trades in a given trading day, right? It's a huge, huge amount. It's a massive amount of stock. On average, GE trades about 47 million shares a day, okay? So how big does an order need to be considered unusual? We're going to talk about that. But before I do, so whether or not you think that a lot of traders and institutions out there have non-public information or not, it doesn't really matter. If you do think that, and you are of the mind that, there's a lot of non-public information being used by institutions to place trades and make money, well then you can stop being mad about that now, because that's actually something that you can use to your advantage when trading unusual options activity, okay? But let's take a look here at an example of a more longer-term type setup, because that is what we're here to talk about. So how many of you here would consider yourselves strictly day traders, meaning you're never, ever carrying positions overnight? You're never carrying positions overnight. Do any of you consider yourselves strictly day traders? So 1 or 2 people saying that they do, but yeah, so a few people saying that they do. How many of you consider yourselves strictly swing traders, meaning that you're never doing a day trade? Yes, a lot more of you saying yes, that applies to me. But chances are that most of you probably consider yourself a little bit of both. Right, exactly, Pat. A lot of you probably consider yourself to be a little bit of both. meaning that you blend day trades and swing trades into a strategy that you're using right now. Well, a lot of people cannot trade as quickly as is required to take advantage of orders like that ALTR order, but that's okay because there's a lot of opportunity for longer term trades. I am a very active trader. I consider myself a very active trader. I trade all day long. I'm in front of my screen from before the market opens until after it closes. I sit around and watch the futures trade. Okay, so I'm able to be very nimble. I can get long a position and exit it in the same day. I can get long a position and exit it in the same minute, right? Because this is all I'm doing. I'm sitting here all day. Even as I'm talking to you guys right now, I have a little alert window up off to the right here that's going to show me if any of my orders get filled today, right? I might hold trades for a matter of minutes before exiting. Not everyone can trade that way. Not everyone wants to trade that way. Not everyone wants to trade that way. Someone says you can make a lot more money if holding overnight when trade is going good. Right, exactly. Right, I can expose myself to a different type of profit and loss dynamic if I consider swing trades as opposed to day trades, okay? If you have other responsibilities, it's difficult to trade very quickly this way. If you have a day job, if you're not in front of your screen all the time. But there are some really great trades that I often pass on because I don't want a holding period that is too long. I want to stay nimble while some traders prefer swing trades. So I actually look at a lot of trades that I say, hey, you know what, this is probably a really good setup here. I really like the way this trade looks hitting the tape. It looks extremely bullish, like someone is coming in here and betting a ton of money that the stock is going higher. But hey, they're betting out through January of 2017. And to be honest, I really don't want to tie up capital that long, right? Or even, I might even see it hit the tape out into December of this year. I might not want to tie up capital that long, okay? But for a lot of traders, that longer holding period of a couple of months might be the ideal holding period for them, okay? It might be the one that they're most comfortable with. So I prefer to stay nimble, but there's a lot of trades that hit the tape in a day that are really good swing trade signals. Let's take a look at an example here back in February. And we're going back to February because just recently, just a few weeks ago, is when this trade started to play out, okay? So we have a trading plan that we developed called the Oak Ribbit Trading Plan. It is an acronym, I understand. I don't much care for acronyms, but it's the best way to remember all of the steps of the trading plan. So we're going to look at this GE order here. And like I said, remember, GE is a stock that trades a ton of stock in a day, okay? And 150,000 lot of call spreads might not even move GE to a point where that's 2 times the average daily options volume. So what's important about this order is the sheer size of the capital requirement that they are putting on to get long GE. So on the 27th, a trader bought 150,000 January 2017 30-35 bull call spreads in GE for 52 cents. So I'm going to use the trading plan to analyze this order and determine if I want to take the trade. The order was placed and is a $7.8 million bet. Okay, does everyone understand how that comes about? So these cost $52 per one lot, and this trader bought 152,000 of them. So it was $7.8 million in capital that they are putting on this trade, and that is a lot of risk in equity options, okay? That is a lot of risk, okay? I can then say, this looks interesting, but does it actually set up for a trade that I want to risk capital in, something that I want to actually put my money into? So let's run it through the Oak Ribbit trading plan. And the first step is to look at open interest. So volume needs to be greater than open interest. Okay, if volume is not greater than open interest, then I have no way of knowing whether or not the trade was an opening or closing position, unless it's also labeled opening. So unfortunately, I can't go back all the way to February 27th to show you guys that volume was greater than open interest. But if you take a look here at the current open interest in these lines, in the 30-35 line, you can see that the open interest right now is 180,000. So it was absolutely volume much greater than open interest when this trade hit the tape. Okay, if volume is less than open interest, then the order could be closing, and I don't want to be taking the trade. So I want to trade opening orders only, and I really want to see huge volume over open interest. Okay? Does everyone understand how if open interest is greater than volume, it's not necessarily an opening trade, right? Yeah, so if there's 5,000 open contracts and I see an order for 5,000 contracts hitting the tape, well, there's 5,000 contracts that could be closing, right? If there's only 1,000 contracts in open interest and I see an order for 5,000 contracts hitting the tape, well, I know that it's not closing because there isn't enough open interest there for them to close, right? So right away, I can look at the volume, look at the open interest, and determine whether or not it's more likely to be an opening or closing position, okay? If the trade does not pass step number 1, that's it. I move on, okay? I just move on. There's no reason for me to keep looking at this if volume is not greater than open interest. So next, the chart. I want to determine if the stock is in bullish or bearish territory on a chart. So how does the stock look on the daily chart? When I'm swing trading, the ideal time frame for me to do my analysis on is the daily bar. Okay, I don't want to be looking at anything faster than that. I don't want to be looking at anything slower than that. Because when I'm swing trading, I know that my ideal holding period is probably somewhere between 3 and 6 months, maybe even less. Anything longer than the daily is going to be a little bit too slow. Anything faster than the daily is going to be too fast. Okay, so stocks trade really well on the daily bar, and when we consider the fact that I'm going to be using the Ichimoku Cloud for my analysis, and we're going to look at that on the next slide here, that is when the daily bar really shows, or really proves to be the best way to go about this. Okay, so I have to ask myself, how does a stock look on the daily bar? This helps me determine whether the order is a speculative bet or a hedge. I can never truly know for sure, but I can use the chart to help determine this. So unless I can see a block of stock tied to the order, or I personally know the trader who executed the order and I can ask them whether or not they have a stock position, I can't know for sure whether or not it was against an existing stock position, okay? My main indicator to determine whether or not the trend would indicate it's a speculative bet or a hedge is the Ichimoku Cloud. So this is very simple. If I see bullish equity options trades hitting the tape and the chart is very bullish, well then I'm more likely to think that it's a speculative bet rather than a hedge. If I see bearish orders hitting the tape and I look at the chart and I see that it's very bullish, well then I say, hey, it's probably a hedge. Puts are probably being bought here against someone's long stock position. Generally speaking, institutional traders are not counter-trend traders. They're not coming in and trying to call a top or get short stock on a 52-week high or try and buy stock on a 52-week low and hope for a reversal. That's typically not what they're doing. They tend to trade with momentum. They tend to trade with the money flow. So if I'm able to determine what direction that momentum is in, I can then, make a pretty good estimate of whether or not they're speculating or hedging a position, okay? Let's take a look here at the daily bar on the Ichimoku Cloud. So it's a lot going on here. If any of you have never heard of the Ichimoku Cloud before, I urge you to go and check out some more information about it. It's really great study. Extremely easy to use, but very complex in its minutia. I can sit here for another 3 hours and talk about just the different components on this Ichimoku Cloud chart, but to anyone who's starting out using it, it's very simple. We have a shaded area here. You see this orange shaded area. Anything trading above the shaded area, and by shaded area I mean this orange shaded area here, anything trading above the shaded area is in bullish territory. Anything trading below it is in bearish territory. On breaks of the cloud to the upside or downside, I also would expect stock to continue with momentum in that direction. Now, the Ichimoku Cloud is a set of moving averages, so all of these are calculated. Every line in this chart is calculated a different way. But really, when I'm trading unusual options activity, all I really want to ask myself is this more likely a hedge or more likely a speculative bet? With GE breaking the cloud to the upside, that's telling me that the momentum is now to the upside. And we take a look here, we can see that there was there's a bull trend line here intact from the lows just before earnings that is pretty strong. So what do I think when I see this? Do I think that as we're breaking the cloud to the upside, as I see the stock continue higher, do I think that institutional money is coming in and getting short this and hedging themselves with call spreads out to 2017? No, that doesn't make any sense. So I know that it's most likely a speculative bet in GE here. I know that it's most likely a speculative bet. The breakout of the cloud here sets me up for a swing trade opportunity, okay? And maybe I don't really know how I'm going to go about taking that swing trade opportunity, but once I see that order hit the tape, hey, they are seeing the same thing. Some institutional trader out there is saying, hey, look at this, we're breaking out right here. This could be a good level for a swing trader for a long opportunity in GE. And then they determine what their price level was. So that's what I want to use is their trade. Okay? So does everyone follow along so far? Does anyone have any questions? Is anyone completely lost with the technical analysis aspect of this? You know, the Ichimoku Cloud is an intimidating looking indicator and study, but it's very simple to use, like I said. Really all you need to take away from this presentation is anything above the cloud is bullish, anything below the cloud is bearish. Use that as a check against unusual option activity to determine whether or not it's a hedge or a bet. So does that make sense to everybody? Everyone following along so far? Everybody learning? Great, 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 great. So the next part of the trading plan is then determining my risk, reward, and break even, okay? I have to understand that institutions have different levels of risk that they can take on than me, right? No matter what I do, I can, you know, not trade outside of the margin requirements that are put forth to me by my broker as a retail trader, okay? Institutions are margined and have capital requirements that are completely different. So they can take on trades where they're risking, you know, they might risk $1 per share to make 5 cents, knowing that they're very probably going to make that money, but knowing as well that they have the capital to pay up if they're wrong. I can't do that, okay? I can do that, but it's really not going to be something that's going to be profitable for me in the long run, right? I don't have the staying power that a hedge fund does, okay? If I lose, you know, if I blow out my account today, I can't just pick up the phone and call up some overnight lender and you know, get some capital to plug up the gap, right? That's not going to, it doesn't work that way for me. Okay, so I have to determine what my risk and reward tolerances are for me. Okay, because it's going to be different than the institutional trader. So I see that call spread hitting the tape. You know, I like the risk versus reward. If I get through, okay, volume's greater than open interest, if I get through the chart and say, okay, it looks like it's a speculative bet to the upside, and then I say, actually, all of that's great, but I don't like the risk versus reward setup, then it's still time to pass on the trade. Okay, so I can measure my risk as a percentage of my book or as a total dollar amount, but in this particular case, I can see that in a $5 wide call spread, they're risking 52 cents to make $4.48. I love that risk versus reward setup. So I know that it passes that test with flying colors, right? Then it's about sizing my trade. I can use, as a swing trader, different levels for stops. If I'm a beginner that doesn't want to risk too much, I can use 20%. If I'm an intermediate trader, I can use 50%. If I'm an expert trader, I probably will not use a stop. And I never use stops in my options trades because I can consider different levels to add to the position if it goes against me. Okay, that's tricky, and it's something that I would only you know, say that expert level traders should even consider doing. Otherwise, everyone else should be having a stop. Okay, so time and target. The timing with equity options is very important, right? It's extremely important. It's one of the most important aspects of trading equity options. Time decay is always happening. I'm always losing money in long options due to time decay. I might not see it. I might not see it come out every day, but every day I do lose money because of time decay in equity options that I'm long. Okay, so I can't say to myself, you know what? Why do I want to buy the 2017s when I can buy the 2016 expiration for cheaper? I don't want to do that because then I'm just flying in the face of everything that I said makes me interested in this trade in the first place. I like the trade because an institution out there likes it. Someone with more capital and all that information and technology likes it better than the 2016 trade. So I need to trade the same time and the same targets as they do. Also, you know, we're able to look and see that all that open interest is still in those. So if I see them selling their position or exiting it, that's when I want to get out too. And as you watch unusual option activity and get more used to it, you can see those orders as they're happening. You can see their entry and see their exit. But watch how the stock moved after this order hit. So a trader bought these call spreads. Since then, the spread has traded as high as $1.04. Okay, $1.04. I thought I had a chart in here of GE. I actually do, yeah. So it's currently trading around 80 cents and nearly 54% profit in a few months, okay? And the spread traded at almost at a double since then, okay? This spread is also less exposed to time decay. So it's a fantastic example of an unusual options activity trade hitting the tape that I don't have to be very nimble to trade, that I don't have to worry about time decay as much, and that I don't have to worry about actively managing like I would something in that ALTR trade, right? I know that it's going to be something that takes some time to develop here. And as we can see, after the order hit the tape, GE did languish for a little while, traded sideways. Then there was some news that came out that they were going to be breaking up one of their divisions and selling it off, and the stock ripped higher. When that ripped higher, stock gaps and the spread gained significantly in value by 100%. It doubled in value, okay? I can also use longer-term swing trades and unusual option activity to try and call bottoms in stocks with much less risk. Like I said, institutions generally do not do that, but one thing that we saw happen here in GoPro was a lot of bullish activity around this level here throughout this time, and the stock has since continued higher and gapped higher here on earnings, okay? Our head trader was able to take advantage of that using the same type of strategy that we're talking about in the GE example. Okay, it's a much more risk-efficient way of taking that type of view and taking that opinion on a given stock. Okay, so I want to take as many questions as I can from you guys. Before I do want to tell you guys a little bit about what some of our customers have had to say about trading unusual options activity with us. Carol says, I know I've said this at least a few times before that I have had my best day ever in KOTM. Today I sold 50 craft April 67.5 calls for a massive, massive profit. I sold some at the open, and the rest a few hours later. There is no better room than KOTM. Charlie says, I want to take this opportunity to thank you for sharing your trading experience. Having just joined your trading room a couple of weeks ago, I made $27,000 in craft this morning thanks to unusual options activity that you taught me. And Matt, this is our most successful customer last year, said trading with KOTM has been very, very good to me. Matt profited over $1 million last year. So all of these traders are finding fantastic success trading this unusual options activity plan. So right now, I would like to offer you guys the chance to attend our swing trading unusual options activity workshop that we'll be hosting live on June 25th at 8 p.m. Eastern time. And we're only going to be offering 35 spots to you guys today because we put together a special offer for this particular event. We're going to give it to you for an 80% discount, but what we're going to cover is how to swing trade options positions with holding periods between 6 months and 1 year. Okay, so for someone who's not quite as nimble or wouldn't consider themselves a day trader, how to trade short-term bottoms or tops in stocks with less risk using options as swing trades, how to avoid losing money in options via time decay by using spreads and complex option strategies, and an A to Z trading plan for swing trading these positions. So you're going to learn how to time entries, where to put stops, where to put profit targets, and a systematic method for analyzing and evaluating every single setup that you might see come across. And this plan is particularly suited for momentum names like Apple, GoPro, Alibaba, and any other stock that you would see unusual options activity in. So we're going to offer this to you guys today for only $97. So for $97, you get to come to the course live on June 25th at 8 p.m. Eastern Time. You also get a recording of it afterwards. So once you attend it, you get the recording afterwards, and you can watch it forever. You get to have that for the rest of your life. And in addition to that recording, it also comes with some other supplemental materials as well to go with it. So it's the most comprehensive course for swing trading and usual options activity. The link here is optionsonthefloor.com/yes. I actually think that you can remove this slash after the yes there. Optionsonthefloor.com/yes. I'm going to put the link in here for you guys. Yeah, so Thinkorswim has a scan for options activity that you can scan for pretty much anything with. It's not quite as robust as Trade Alert or Option Hacker, but if there's names that I like to trade, you know, if I'm looking for a potential play in a stock, Thinkorswim has a very detailed time and sales window for options that can let me sort through very quickly by size all of the equity options orders that took place in a day. All of the orders that take place in the day. So does anyone have any questions about anything that we went over here? Does anyone have any questions about the course that we're offering here on June 25th? So do you have trades for 1 week to 2 week month time frames? Yeah, absolutely. So, and this is kind of the thing about swing trading. I don't necessarily like pegging myself as a swing trader, because what is a swing trader? Is a swing trader someone who holds a position for 2 days or someone who holds it for 2 months? So what we're going to talk about in this trading plan is, all right, once I see an order hit the tape, once I have a trade that I want to execute, where do I put my profit targets? And really the trade's lifespan is all depending on whether or not it hits that stop loss or whether or not it hits those profit targets, right? If I was someone who waited in GE, you know, till a little bit closer to when that event came out to get into the position, well, I probably would have gotten most of my profit targets in a day, right? Like if I would have bought that spread the day before that news came out, I probably would have gotten all my targets in a day, right? So yeah, a lot of these trades take a little bit longer, but the holding periods can be 1 to 2 weeks as well. It's really all about what happens in the stock, right? I might have a view that Apple's going to get to you know, 140 by September. So if I put on a trade with that view in mind, you know, if it happens next week, then it happens next week, great, right? You know, my holding period was intended to be out to September, but I got out a little bit earlier because it went in my favor. So we're going to talk about trading outright calls and puts. We're going to talk about trading spreads, and we're also going to talk about some other more complex strategies that are not call and put spreads. See, a lot of questions you guys are asking here. Is there a very beginner's guide to options? The jargon and complex strategies confuse me. Okay, so the jargon, yeah, the course is extremely comprehensive. It goes from step 1 to the end, right? Step A to step Z. All right, I honestly believe that anyone with any amount of options knowledge can take this course and learn how to do this trading plan. Okay, I really do think that. Let me tell you guys a little bit about my background. I graduated from the University of Illinois here in Illinois, in Urbana-Champaign, with a degree in finance with a focus in financial engineering and derivatives trading. Okay, I know all of the jargon. I can tell you all of the academics about options, but it wasn't until I started actually trading and applying ideas like this that I actually found value in trading options. Okay, before that I was trading futures. Now I only trade, pretty much only trade equity options. So I really think that your level of knowledge doesn't really matter, right? It doesn't really matter as long as you're able to follow along with kind of what we did here. The terms are not something that's going to confuse you too much, and especially considering that you get the recording and you can go through it as many times as you want afterwards. I think it's fantastic opportunity to learn about unusual option activity if it's something that you're interested in. What are my thoughts on Tesla and BABA for earnings? Well, I think that Tesla, I'm going to trade Tesla earnings today, and I'm probably going to get short. I'm not sure though. I have to take a look at it again. This is the time of day that I normally set up my earnings trades, but I'm talking to you guys now about trading unusual options activity. Do we need trade alert software to make trades following the course, or can we trade without it? Yeah, so we're going to talk about trading this unusual option activity. We use Trade Alert. There's a lot of other things available to you, or something as simple as your time and sales in your Thinkorswim platform. would have the ability to do that. Something as simple as, the scan function in thinkorswim, right? Because, Trade Alert is great. I use it every single day, and I don't know what I would do without it, but that's because, most of my trades are happening in a day, right? I'm really kind of flipping in and out of things a lot, okay? I don't need that instantaneous kind of access to information and signals hitting the tape if I'm trading with this type of plan, where I am looking at a more, longer term type of setup. I can take my time a little bit more, so something, less expensive or free, like the thinkorswim one, will do me just fine for this. Chart Ichimoku on thinkorswim. Yeah, so thinkorswim has the Ichimoku Cloud. It comes with it for free. It's just part of their regular charting package. So optionsonthefloor.com/yes. Please, please, please take advantage of this. Typically, our presentations that we do, these workshops that we do, go between 2.5 to 3 hours long, depending on the questions. They go between 2.5 to 3 hours long. So any other questions? Guys? I think I'm almost out of time here, if I'm not mistaken. On the hour here is when I'm done. So I have a few more minutes and would love to answer any other questions you guys have. But yeah, thinkorswim has the Ichimoku Cloud. I use it all the time. I use it every day. I'm going to show you my thinkorswim here. See, very simple. Just in thinkorswim, click the studies button, Ichimoku. I use the standard settings. I don't tweak any of those. Question: if you're looking at option trade, is there generally enough option volume to allow followers to get into an option without a huge price slippage? So it all kind of depends. When we look at an example like ALTR, I mean, there's going to be slippage just because as soon as an order like that hits the tape, implied volatility goes higher, pushes options premiums higher. Different algos see that, they chase it. The stock can move higher. As a big block of calls is bought, the market maker that sold the trader those calls has to buy stock to hedge himself. That also pushes the price of the option higher. But when we talk about the more kind of swing trade type of style, it's not really that present, right? That kind of really fast pop, in the options doesn't really happen that much, right? If someone comes in and buys 150,000 GE call spreads out to January, it's not really going to cause a huge spike right away. There's going to be plenty of time for me to think about that trade and decide whether or not I want to get into it. Does that make sense? Does that kind of answer your question, David? Can anyone show us how to make a SDIRA? I'm not really sure what you mean. Great. SDIRA. Oh, is that some type of an account? I'm not sure. Not an expert. Yeah, self-directed IRA. Yeah, I would say call your broker. That's not. I trade through a margin account, just like most people do. With a 6-month to 1 year position, would you ever buy a deep in the money strangle on a leap for up to 215 premium of intrinsic value and then trade? Okay, I mean, so typically speaking, that's not, I mean, and that's a pretty complex thing that you just described there, but typically speaking, I'm not doing that. I'm trying to follow institutional order flow. So if I see an order like that hitting the tape that in size that is interesting, then maybe I can start to think about doing something like that. But otherwise, that's not really something that falls inside of my wheelhouse, right? I'm looking for this type of, when I see that GE trade hitting the tape, I'm taking that GE trade. I'm not trying to tweak it. And that goes back to my whole time and target idea. And hey, if they put all this time and energy and analysis into this trade, am I going to come in and try and say, you know what, I think I'm smarter than you guys, and I'm going to change it, right? and I'm gonna do something different, right? They put a bunch of money into it too. You know what? You and your $7.8 million are wrong. I think I have a better idea. Let me do that. No, that kind of completely defeats the point of looking for the order flow, right? If I find the order flow that indicates unusual activity and then don't trade it and then trade something else, I'm really kind of, what am I doing? I'm kind of trading backwards, right? Does that kind of make sense, John?